Yeah, so the third is that the market is still trying to understand how much is priced into AI. And so it's in our view is still a strong narrative. Uh, but as you know, um, there's questions about the longevity, how much energy we really need, data center capacity. And so until the market is comfortable that there's other stronger narratives, which I think there's plenty, like the ISM is turning up. I think housing could recover as rates are cut. But that transition again would cause uncertainty. So I'm guessing that the three collectively could cause a drawdown that feels like a bear market.
Tom Lee is not walking into 2026 waving a doom sign. He's doing something more interesting and, for investors, more useful. He's mapping out why a bull market can keep going while still delivering a gut check sell-off that feels like the real thing. That distinction matters because bear market is not just a number, it's a mood. The kind of mood that makes smart people do dumb things at exactly the wrong time.
Yes, that's right. I think when we look back at the end of this year, I think 2026 will look like a continuation of the bull market that started in 2022, but and really a period when economic resilience is much more visible. But at the same time, there's two, I think, substantial transitions that the market has to grapple with. Maybe three. One is, of course, a new Fed, and the market always tests a new Fed, and that process of identifying and then confirmation plus the market test can create a correction.
That's the setup. He's not saying the long-term story is broken. He's saying the market can get rattled while it's still technically healthy. A new Fed alone can be enough to spark a correction because markets don't politely wait for clarity. They test the new regime in real time, and the test can get rough.
And I think that in 2026, our view is that the White House is going to be more deliberate in picking winners and losers. In 2025, that caused a lot of disruption for technology, IT consulting, and for healthcare. And this year, there's a lot more industries and sectors and even countries in the bullseye. And I think that that creates uncertainty. You can tell by gold's rally. And so I think those two factors can cause a drawdown in 2026.
Now you can hear the ingredients he's pointing to. This is not just about charts and technical levels. It's about the rules of the game shifting and entire sectors not knowing if they're about to become targets. When uncertainty rises, money does what money always does. It looks for shelter, and he's using gold as a visible signal that plenty of investors are already on edge.
That's right. Every pullback has been a great opportunity. Last year, the tariff related drawdown was on April 7th, turned out to be one of the best entry points in the last 5 years for anyone buying stocks. There were so many stocks that made new all-time highs, but really explosive rallies. So I think this year, if what we think happens, it's going to be a great buying opportunity.
This is where his reputation shows up. He's basically saying, I've seen this movie. And he's reminding listeners that the pain of a drawdown often hides the gift inside it. The hard part is psychological. People hate buying when headlines are loud, but his whole point is that the best entries rarely feel comfortable when you're living through them.
Yeah, in fact, I think 404 still look quite visible. The US does have a favorable demographic tailwind that is in contrast to other countries where the prime age workforce has gone into deficit. In terms of inherited wealth, I think there's a lot more conversations about it that Gen Z and millennials and Gen Alpha, they are set to all inherit substantial sums of money over their lifetime.
Here's the longer runway behind the short-term turbulence. His argument is that powerful tailwinds are still blowing. Demographics, wealth transfer, and the US sitting at the center of major innovation waves. That's why he can sound bearish about a drawdown and still sound bullish about where things go after. It's not a contradiction, it's a timeline.
And then with regard to AI, I would say that, you know, evidence that we could be moving towards super intelligence is accelerating, and I think there's a lot more progress being made on robots and integration with robots. So those are all things that are going to favor the U.S. And then on blockchain, it's not just BlackRock and Robinhood anymore. Jamie Dimon has publicly stated that he thinks blockchain does fix a lot of problems for financial services. So I think the banking industry is starting to embrace the efficiency of blockchain.
This is where his 2026 could be rough warning gets balanced by a future keeps arriving anyway argument. Even if AI is overhyped in pockets, the trend is still moving forward. Even if crypto gets volatile, the underlying idea of blockchain in finance keeps spreading. He's painting a world where the long-term direction is clear, but the path is jagged, and 2026 is one of those jagged stretches.
Margin debt is something we can watch, and we've been tracking it. NYSE margin debt is at an all-time high, but it's only risen 39% year over year. Usually for a local top for markets, you want to see that rise 60% year over year. So there's a chance for essentially leverage to accelerate, and then that marks a local top.
Now he gets more tactical, without pretending anyone can time this perfectly. He's pointing to leverage as the accelerant. When markets are calm, leverage builds quietly. When leverage gets too hot, a small spark can turn into a big sell-off. His warning is basically, watch the fuel, because fuel is what makes a pullback feel like a crisis.
Yes and no. I think that last year investors did a fire ready aim. Whenever they saw the tariff conversations escalate and become uncertain, the market really reacted poorly and fell sharply. I think that this year markets are going to be a little more measured. So let's say it's half the amplitude of reaction. But then there is still the uncertainty of how the Supreme Court will rule around the tariffs. And maybe if that rules against Trump, then it's going to look like the leverage of the U.S. has dropped. And so the White House might take more extreme measures. That could cause greater uncertainty.
This is a key piece of his 2026 turbulence case. He's saying policy uncertainty can hit markets fast, and even if investors become less jumpy than last year, the uncertainty doesn't vanish. It just changes shape. If the legal and policy landscape turns into a tug-of-war, markets hate that kind of ambiguity because it's hard to price.
But I think there are still voices in the White House that are kind of saying, let's not undermine the Fed completely, because markets know and market history knows that the Fed is still the most important entity in the world. And to undermine the credibility and the independence would unleash a lot of uncertainty. We also know Fed Chair Powell's term is up this year. So there's a bit of like let the clock run, because we know that there'll be a new Fed chair.
Put that together, and you get the story he's really telling. 2026 can deliver a drawdown that feels like a bear market, because several pressure points can hit at the same time. A Fed transition, policy fights, and questions about what is truly priced into the biggest narratives. But he's also saying something that's easy to miss. A scary year can still be a constructive year, especially if the market ends up digesting the uncertainty and moving forward with a cleaner slate. We covered why Tom thinks a pullback in 2026 could feel like a bear market, even if the broader bull market remains intact. We walked through the three big transitions he's watching, why policy and Fed credibility matter so much, and why leverage can turn a normal correction into something that feels brutal in the moment. And most importantly, we heard his framing. Volatility is not automatically a signal to run. It's often the entry point that long-term investors end up thanking themselves for.
Yes, I think the most important advice I can give people is that trying to time the market makes you an enemy of your future performance because a lot of investors always only want to buy at the bottom and they want to sell at the top. But when we look at the stock market and actually in crypto too, um, the only people who really make money are those who are investing for the long term. So as much as I'm warning about 2026 and the possibility of a lot of turbulence, they should view the pullback as a chance to buy, not the pullback as a chance to sell and to avoid stock.
So if 2026 does deliver that ugly, headline-grabbing drawdown, do you think most investors will treat it like a trapdoor, or like the buying window Tom keeps talking about in this interview?